Good morning and welcome to Charting the Markets on Tuesday, the 12th of December 2023. US markets once again rose yesterday, and most Asian markets did so as well on the back of that, except the Nikkei 225, and we'll get to that in a minute, which is still underperforming. And all of this is happening ahead of today's US CPI reading, the consumer price inflation data out for November, where we expect to see a fall to 3.1% year on year from 3.2% in the previous month, and core inflation to stay at 4%. Right, let's begin by having a look at the Nikkei 225, as I've just mentioned. We can see it here, and it's basically coming off again, having yesterday risen close to its November to December downtrend line here. So it is trying to hold above the red line here, the 200-day simply moving average around 32,049, and to rise back into its previous highs going back to July of this year, but is finding it difficult to do so. So we'll have to see what happens with regards to the breakout. Will we have a breakout through not just the downtrend line, but also the last reaction high, that is to say the 6th of December high at 33,462, in which case we could actually retest these highs and rise towards the 34,000 area? Or are we once again going to come off that resistance area and fall back towards not just the orange line here, the 55-day simple moving average at 32,471, but also the red line, the 200-day simple moving average at 32,049. So the jury's out on that one, but the Nikkei is clearly underperforming at the moment. When we look at the UK, we can see here that the story is slightly different for the FTSE 100. I mean, it is still underperforming most other equity markets, having just gone back into positive territory for the year. But also, as we saw UK unemployment hold steady at 4.2% in October, while wages grew more slowly for the 3 months to October than had been anticipated at 7.2%, I should say, versus a 7.7% expectation and an 8% previous reading. The FTSE 100 did rise on that to the September to December downtrend line, which is currently capping further upside here, as you can see. So we're trading once again around the 200-day simply moving average, 7,564. And the trends still remain intact from a short-term perspective, provided we stay above Monday's low at 7,492. Further upside is likely to be seen. But ideally, what I would like to see is a close above this September to December downtrend line, in which case, in the course of the next few days into the end of the year, we may actually rise back towards the October high at 7,702. So that is currently still on the cards, but you can see the FTSE 100, which has been suffering yesterday, for example, because of weaker mining stocks over the last few days, is still underperforming other European assets classes and especially equity markets, such as, for example, the DAX 40, or in the US, the Wall Street, basically the Dow Jones Industrial Average, as you can see here, which has been rising very steadily and very sharply over the last 6 weeks, ahead of today's CPI print in the US and also tomorrow's FOMC meeting. So here we've risen to 36,460 so far. And if I go back to a weekly chart, we can see here that we are very close to our all-time record high, which was made on the 3rd of January 2022 at 36,954. So that is the next upside target for the Dow Jones Industrial Average, and basically this will remain in play as long as we stay above Friday's low at 35,965. So that is the level to watch out for in case of reversal being seen. But right now, the trend's your friend. That's still very much pointing higher. Now, obviously, we have to see whether a higher reading in today's inflation data could lead to a short-term consolidation in US equity markets. And also, if the Fed tomorrow were to refute in strong terms the current expectations around rate cuts next year, that could also dampen the upside with regards to equity markets in the US going forward. But if we look at the Nasdaq 100, for example, we can see again here we're also heading towards new highs, 16,267. That is a level last seen back in January of 2022, and here we're also approaching the December 2021 high at 16,660, and above there also the November high at 16,769. So these are the upside targets for the Nasdaq 100, but we can see here that we are on track for our 7th consecutive week of gains. But as I said before, we'll have to see whether the US inflation data does continue to come off as is currently being expected by the financial markets. As you can see here, that's why they're rising, and also because they expect, or market players expect, rate cut expectations to remain in play. And so far, we're expecting to see rate cuts, a first rate cut in the US towards the end of the first quarter, or perhaps the beginning of the second quarter. And we'll have to see whether after today's inflation data and also tomorrow's FOMC meeting, this will still be the case with regards to forecasts by financial market participants. Because if that's not the case, we could then see a retracement lower, and that could take us, in case of the Nasdaq 100, back towards the late November high at 16,126. But from a technical perspective, the medium-term uptrend will remain in play as long as the current December low at 15,692 underpins. The US dollar continued to grind higher over the last few days, and you can see the inverse of that on the daily euro-dollar chart. But yesterday it was slightly different in that the euro actually did bounce back, as you can see here, and is now heading today towards the 200-day simply moving average here in red at 108.26. So that might once again cap the upside together with the July low at 108.34. And as long as that's the case, the recent downtrend is actually likely to continue. So basically, as long as we stay below 108.34 on a daily chart closing basis, we may actually, over the coming days, slip back again towards this week's low at last week's low at 107.24, and also towards the 55-day simply moving average at 106.99, and also the late October high at 106.95. So these are still possible downside targets, provided we stay below 108.34. But right now, we're heading towards that resistance area ahead of this afternoon's US CPI data release at 1:30 p.m. UK time, and where we expect US inflation to dip down to 3.1% year on year from a 3.2% reading in the previous month. Cable, the US dollar versus the, well, I should say the British pound versus the US dollar, which also retraced low over the last few days, did hold above the 200-day simply moving average here at 124.93, and is trading in a very low volatility and low volume trading range, as you can see here. And not much is really going on here. But if we were to take out yesterday's Harami high here at 125.91, we could then head to the mid-August low at 126.17. But the 125.91 high so far is the late June low, which caps the upside at the moment, but is still in view short term as the British pound tries to appreciate versus the US dollar. If you look at the euro against the British pound, you can see here that basically we are trading a short-term sideways trading range above this week's low at 85.50, and are trying to regain upside momentum here as rate cuts by the European Central Bank look to be more likely than any with regards to the Bank of England. Now, obviously, both of these central banks will report and have their monthly meetings and talk about their interest rate decisions on Thursday, together with the Swiss National Bank as well. So that might give us more indication about the future monetary policy going forward. But at the moment, it looks as if the European Central Bank has a slightly less hawkish stance than the Bank of England. And on that expectation, the euro is so far still holding, though. As you can see here, the euro is not weakening against the British pound, and instead rising back towards the mid-October low at 86.60. 17. So that would be our short-term upside target. But it doesn't look as if it is going to happen with much impetus, because the recent decline we've seen in the euro versus the British pound on those rate cut expectations, which have been moved forward towards the end of the first quarter of next year, perhaps the beginning of the second quarter, and rate cuts in total for the year being increased to between 100 and 125 basis points for the European Central Bank, versus none of that really being priced in to that degree for the Bank of England, has led to the sharp sell-off in the euro against the British pound. Let's have a look at the oil price now, because that is also gradually grinding higher again, having slid very sharply with regards to WTI. As you can see here, last week we had 5 consecutive days of falling prices as a postponed OPEC Plus meeting and squabbling OPEC Plus members with regards to output cuts had pushed the oil price lower whilst supply was very ample. But since then, we are gradually grinding up again, as you can see here, but with a loss of upside momentum, with a loss in volatility, and also a loss in trading volume. So not much really going on here. We seem to be flattening out below the mid-November low at $72.38, which may act as resistance going forward. If it were to be taken out, there's further resistance between the early November low at $74.92 and the psychological $75 mark. But as you can see here, not much going on with regards to this minor bounce that we're seeing at the moment. And the trend is still actually pointing lower. As you can see here, we have a series of lower highs and lower lows. So I wouldn't be surprised if over the next few weeks, we may actually slip below the current December low at 68.99 on this front-month futures contract, which would then take us back down again towards the May and June lows between $67.13 and 12 cents. Let's have a look at Chicago wheat, because that is also looking interesting. You can see here the wheat price, which rallied last week and rallied for 8 consecutive days. Yes, it did so, to the 200-day simply moving average on reports that 3 drones by Houthi rebels had hit oil tankers, and therefore potentially affecting the supply of wheat, wheat, not oil, had risen to the wheat price had risen, but basically profit taking, and also as China continues to keep buying US wheat amid ample supply, has led to the wheat price coming off again. And interestingly enough, here the 200-day simply moving average at 640.3 acted as resistance for 3 days last week. So now we seem to be heading back down again towards the orange line here, the 55-day simply moving average at 592.36. Even if short term, we seem to be flirting with the early November high at 617. So as long as we stay below 650, I expect the recent advance just to have been a blip in this sideways trading range with a slightly negative bias, which we've been in since July of this year. So probably further downside being likely seen in the days and weeks ahead with regards to US wheat prices. Now, New York cotton prices are also interesting, because you can see here on the front month futures contract, you can see that we seem to have ended what looks like an Elliott wave ABC upward corrective move in a downward trend, which we've been in since September of this year, and did so between the 55 and 200-day simply moving average and along this tentative October to December downtrend line between basically 83.06 and 83.31 on this front month futures contract. So as long as that resistance area continues to cap, we are likely to continue to trade sideways. And if we were to fall through last Friday's low on this New York cotton front month futures contract, that was made at $81.25 on the futures contract. If we were to fall through 81.25, then we could have a slip take us back down towards the psychological 80 mark, and perhaps even towards the early December low at 78.71. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X. My handle is @AxelR_IG.